So this last session is on tax planning and record keeping for farmers and food businesses. And I put food businesses in a much smaller font because it's really, I mostly deal with the farm tax issues and stuff, but a lot of the things that is in this presentation are really for both. And I left, this is a presentation that was put together mostly for an earlier event in December. And so I had some co-authors that helped me put the presentation together. And so I left a lot of their slides in there, so I want to recognize them. And so we'll go forward. So USDA has some different portals, and then I actually am working with USDA, and I'll show you some of those, but they have farmers.gov/taxes, and then I run the ruraltax.org website. And so ruraltax.org should get you to everywhere, all of the resources, both on the USDA website and mine. And it's materials created by the National Farm Income Tax Extension Committee, but is hosted here at Utah State University. And I and Adam Kantrovich from Clemson University are the co-chairs. And so it just has a lot of different materials based upon taxes. And we always have to do disclaimers. So this is not USDA's, this is rural tax education, and we're land grant universities, da 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 da. Also, the other thing that I want to do as a disclaimer is that everything discussed when we get into the realm of taxes is general. So I'm just going to do some kind of overview things, and with every tax and legal situation, the exact answer really does vary based upon some really kind of nuances and the facts and circumstances of the situation. And so these are meant to be some overviews and just to kind of get a lay of the land, but really you're going to want to go to your individual tax professionals for further guidance. Also, the presentation is only good up to the day it was written, because if we do have changes in tax law or the guidance changes at the IRS, then, and we may, I think within this next year, may have some new tax laws changes. So here's what I'm going to cover today. We're going to start out with some records. What records do you need to keep, and how to work with a tax professional? What do you need to take to a tax professional? The tax and how grants work. I know that came up in an earlier segment with the business builder, if that was taxable. We'll go over that. Tax management, just some general things, and some potential for tax law changes. And this presentation is just going to maybe introduce you to a lot of these resources, and then you can go back and dive in deeper if you'd like to. So one thing that I like to point out is the goal of tax management is to maximize after-tax income over multiple years, not to minimize the taxes paid. Because a lot of times people will say, I really want to minimize my taxes, but if you lose money in your business every single year, then you can minimize the taxes paid, but it's in no one's best interest to do that. And so the goal of tax management is really, how can I really maximize my after-tax profit? And we do it over multiple years, because some things like depreciation, we might take most of those deductions up front. And if we do so, then that leaves fewer deductions for the future years. And so it's really kind of looking at how do I maximize it over those multiple years. So the first thing we're going to go over is records and working with a tax professional. So various organizations have record keeping requirements. Banks, lenders, Farm Service Agency, Internal Revenue Service, State Department of Revenue, insurance, EPA, U.S. Department of Labor, the Food and Drug Administration, USDA, state departments, and other regulatory things. And so you may have to keep records for all of these things that you're involved in, and they might be slightly different. Today, we are really going to go over so we're going to go over more from a tax standpoint, what records you need to keep, and dive into it. But I feel like I don't want to start there without kind of recognizing that when we talk about record keeping, there may be more records that you'll want to keep. And when you start to kind of put your record keeping system together, it's important to keep track of your activities during the year, financial activities, production activities, food safety, employee, etc. financial things to get your revenue and expenses. And one thing that I really want to point out is that if you have a farm or a food business, you need a separate bank account. Well, you're not legally required to, but I would suggest you have a separate bank account for the farm business separate from your personal account. And if you have a food business and a farm business, you may actually need to have a farm account, checking account, and a food business checking account. And then you want to reconcile those in a timely manner. And also, all of the value of this stuff is really, you may even need to meet with your tax preparer more than once a year. You may need to meet with them during the year because there's some things you can do before the tax year ends versus just getting your tax filed. So we're going to start with how long should I keep records? The tax period of limitation. So generally it's 3 to 7 years. Indefinitely, if there's no return was filed or there was a fraudulent return, then they can go back longer than that 7 years. Property and fixed assets, you want to have 3 years from disposal, and so you may be keeping those records for a long period of time. Major items, keep indefinitely. And then tax-related employee records, 4 years from the tax due or after the tax is paid, whichever is later. So that's kind of the general limitations that are in the code. Here's some good practices. So if in doubt, keep it. And then your financial records, keep them for a 7-year minimum. All records related to employees, you'll want to keep for about 10 years. Your general ledger and financial statements indefinitely. Some of the ownership information documents indefinitely. Business meetings indefinitely. Part of this business meetings is because for some of the structures, like a corporate structure or an LLC or some of those things, sometimes you have to go back and really kind of prove that you were operating as that structure. The other reason is because if things were discussed in that business meeting, that may be what defines how you do something later. So if this is what was agreed on in the meeting, then, going back to those business meeting records. Deeds, you'll want those indefinitely. And then really have your once a year cleansing day. And this is just taking your long-term files and putting those maybe more into a longer term storage and then starting your file storage for the next year, and also cleaning up your electronic files and every year and kind of getting those organized. So you can have some of your records kept in like those tote boxes that you buy, at several different stores. And so it may be labeling, here's my 2024 one, and I'm going to put that down in the basement, and then I'm going to start my 2025 one. On the records that you keep, we really have a concept of you need to keep its constructive receipt. And constructive receipt says we need to be able to know when did it occur, where was it, and what was purchased or sold. And so those are really kind of the overlying 3 things that we want information from. So for example, for my checking account, I might have on January 18th, 2024, I had a $1,200 charge from the co-op, or I had a check made out to the co-op. But I know when it occurred from that. I know it was at my co-op, and if I only have one and that's the one that I work at, I probably know where it was. But I really don't know what was purchased or sold here. It's not enough information. And so I really need to know that 450 of that was on fencing, $400 was on irrigation supplies, and 350 was on seeds and plants. So my record keeping system needs to be able to break it up into those categories. Your record keeping options, you can do manual ones, you can do Excel, QuickBooks. There's also some like PC Mars. That's one that's for agriculture, and it was put together by Iowa State University. So you can check into some of those. And there's others out there, and then point of sale systems and other types of things. But here's some just general overview. So what do you need to take to a tax professional? The summation of the current year's transactions, and those have to be based on the tax form line items. So farming has a Schedule F, and so some of those line items are things like seeds and plants, a line item for rent, a line item for fertilizer, etc. And so normally that'll be the reports from the accounting software. but again, you want to match them up with those lines on the tax form. Capital, you'll need to also take in a listing of the capital asset sales and purchases. So that's the equipment, machinery, land, buildings, any kind of transactions where you bought or sold those types of things. The 1099s received or sent. So the ones, 1099 is an informational form that has certain requirements that as a business, you need to send it out to non-corporate businesses under certain circumstances. And I'm not going to go into all those, but I'll tell you where you can find more information on them. And as a business, you may receive some 1099s, or as an individual, I get one from my bank if I have any interest or anything. And so those 1099s, end of year statements such as a financial institution debt or loans, other income producing accounts, any forms, documents for employee transactions and changes, and then the end of year information on insurance. So that's really kind of a big, broad overview of record keeping and how to work with a tax professional, but it gives you a few guidelines. And then the next thing I want to go into is it a farm? And so the tax definition of a farm is a business with a profit motive. And so the Internal Revenue Code, and I include the Internal Revenue Code numbers in the citation here because you don't need to know that, but if you do want to have something that you take back to a tax professional or somebody else, that's the IRC section 2032A E4 is what can tell them where to go looking for what you're talking about. So a farm includes livestock, dairy, poultry, fish, fur, fruit, and truck farms. It also includes plantations, ranches, ranges, orchards, and groves. And I had not heard of a truck farm, but a truck farm is just a word for a vegetable farm because it dates back to when the code was written. People would bring their produce in on their truck and then sell it off the truck. So they called them truck farms. So crop farms, cattle ranches, orchards, vineyards, vegetables, all of that is a farm. So who is a farmer or rancher? The publication 225, the Farmer's Tax Guide, defines a farmer or rancher as an individual in the business of farming if you cultivate, operate, or manage a farm for profit, either as an owner or a tenant. And the definition also applies to if that's done as an LLC or a partnership, a corporation, or an estate and trust. You're still qualified as a farmer. This is not farming. So not farming is if you're doing custom harvesting, that's using your equipment to do some type of a service for somebody else, like plowing their field, custom farming, custom harvesting, trucking of farm commodities to markets, not consider a farming activity. However, if you're using that same equipment as part of your own farm, so I'm raising my farm commodities and I'm hauling my farm commodities to market, that still is considered all part of the farming activities. But if you use your trucks to haul somebody else's farm commodities, that's where it wouldn't be necessarily considered farming. But there's a but. So I'll just, and the but is that if we do, it's called de minimis, but if you do a small amount of, so I'm in the business of farming, I have my farm, and I have a tractor and a plow. And so a neighbor wants me to come and just cultivate, you know what I mean, their little area. And so if I do just a small amount of it, and they call it a small amount de minimis, it's a Latin term for just a small amount, then you can still include that small amount with your farming activities as part of the farm on the Schedule F on your tax return. However, if it starts to be a bit larger amount, then you really have two businesses. You have your custom farming or trucking business, and then you have your farm. But as long as it's for your own farm services, and then you're just doing a little bit on the side, it's okay to include it as part of the farming activities. So processing of farm commodities into value-added wholesale or retail products, so like cheese, cuts of meat, wine, strawberry jam, all of those types of activities are not considered farming activities. They're a Schedule C, we call them Schedule C, but just a business. And so farming has its own Schedule F. So they split out farm business activities from all the other activities. And that's why it's important to really kind of have this distinction here with all of these things. But again, it's not really in the Internal Revenue Code, but it's kind of agreed upon that if you're doing a very small amount of selling a processed food product compared to your overall operations, then you can still include that small amount of sales as part of your farming operation. But when it starts to become more significant, then you really need to split it off, and you have two separate businesses. You have the farm business, and then if you were doing like strawberry jam, you'd have the strawberry farm business, and then you'd also have the jam business. But if you're just selling a little bit of jam, then you can go ahead and just do it as part of your farming activities. So the records with value added are going to be a little bit more complex because you probably have more than one business. And so it's a good practice to keep separate records. So the expenses and receipts need to be separated for the tax return so all the expenses and receipts from the like strawberry jam need to be separated from the expenses of actually growing the strawberries. And so in that case, the strawberry jam business, your strawberry jam business would actually purchase the strawberries from your farm business, and you'd want to keep those separate. So tax on grants, and this came up, I think, earlier in the Business Builder Award discussion, but unless specified otherwise in some type of law or code, grant funds are taxable. And so in general, they are taxable. There's been a few exceptions over the years, and there's a few things that are, but in general, grants funds are taxable. So the Business Builder Award funds would be included as income when you receive funds from that. Not when you receive notice that you've got the grant, but when you actually receive the cash. Those funds are going to be taxable, and you'd include them on your tax return. However, though, they're giving you, those funds are provided to purchase equipment or pay for labor or other types of things. And so normally what you use those funds for can also be deducted on your taxes. And so you would have the money coming in showing it as income on your tax return, but you'd also have the money going out showing it. And so really the net is not, you shouldn't have a net big tax obligation because you should show as many expenses from the grant proceeds on things you used them for as you do the grant proceeds themselves. But there could be a timing issue if you do the expenses in one tax year because you buy all the things for the grant in one tax year, and then the grant gives you that money back in another tax year. And so you really want to try to avoid those those timing issues to have that in different years, because it could show a lower than normal income in one year and then a higher than normal income in another that can kind of mess you up. So we do have more information on that in worldtax.org, and I'll show you how to find some of those individual things on the website when we're through the presentation. So I want to also go over a little bit with some tax management. And this, again, is going to be just an overall kind of seeing where we are. So tax management is a basic part of any business management practice. And when you think about it, a lot of times for situations, if you're a profitable business, it may be one of your more significant expenses also. And so I think it's important to kind of have some understanding of what is driving it, what's going on with it, and then also how to manage it. And tax management is not how to get out of paying taxes, but it's because it could come back to bite you. Because one thing is, it might be that you're deferring taxes until a future year with some of your choices on tax management. And if you do so, then when you retire or after death, you may not have the wealth or equity that you think that you have because you have a big tax bill burden that's been kind of just building up over years and years and years. So what we really want with tax management is using the available items that are in the Internal Revenue Code to get the most amount of income through the tax system at the smallest tax rate possible. And really, again, it goes back to that one of those opening slides I had. We're really trying to maximize that after-tax profit. This requires pre-planning, sometimes years in advance. And if you know you're going to like be selling, some equipment or, some land or something like that, or you're going to be retiring or making major changes, you might be doing some things to kind of pre-plan for that. It requires the records, because if they don't have information, then it's hard to do anything. And then it also, you will need to meet with your tax professional probably and kind of go over what are some strategies that we're going to do kind of in advance and stuff. And so understand that accounting, record keeping, tax management, they're really symbiotic. And so we can't really do good tax management if we don't have good records. And we need a good accounting system in order to be able to keep those records and have them as we need them. So those are really kind of if we thought of tax management and overall this as kind of a stool, the legs of the stool are really all of those things fitting together. It's also important to build a team. So the difference between farms that are economically or financially sustainable, and I would say this is also true for food businesses as well as farms, is moving from a producer farmer to a farm business manager. And so being able to properly manage all aspects of the business. So that is where it's really kind of thinking of this as it's another thing to really manage. And the reason I'm managing it is because it really is a very significant expense of my overall operation. And it's going to require a good team. And a lot of times these are going to be people like yourself as the owner, operator, or manager, but there may be some key employees that are helpful in that, tax or legal professionals, financial advisors. You might be working with extension staff or faculty, crop insurance agents, lenders, loan officers. And so really kind of anybody that's there. And I think that what that team looks like is different for each individual business, but just think about, you really do need to have some of these things in place. And the more that you do, the happier kind of and the easier this will be. And you should meet regularly, at least once a year. But a lot of times, some of the things that you can do before the end of the tax year. So like if you're paying on a calendar year, there might be some things that you want to do like in November and December before the year ends versus what you can do just after the year ends, but before you file your tax return. So think about kind of when you might want to meet with that tax professional, and really to make it work well, you probably need to put them in place, like really like May, June, start looking for somebody for the next year. So another tax management strategy is prepays. This is more of a farm strategy than it is for another type of business. So a food business wouldn't really work with this, but farms do, because farms file their tax return mostly on a cash basis. And so if they purchase products that they're going to be using over the next year, like fertilizer, fuel, seed, before the end of the year, then they can deduct those costs in the year that they purchased them, because they're filing on a tax basis. Food businesses cannot deduct the cost of goods sold until they actually use those cost of goods sold. But farms, the tax situation is different. It works differently. You must prove that there may be difficulty getting the products when needed, and or you must prove that you're able to pay a lower price than at the time of need. So if I think that the prices are going to be going up, if I want to buy those earlier because I can buy in bulk, or sometimes they run out during the growing season, so I want to make sure that I have those. And again, you need to show constructive receipt, which means that not just the money put into the account, but you've actually identified the products being purchased, the quantity, the price per item, all of those things. It can't be more than 50% of your total deductible farm expenses. And then another way, and this can be used by both farm businesses and food businesses, is depreciation. To claim depreciation, an asset must be placed in service. So if it's a piece of equipment, you have to have physical possession of it, but placed in service for like a tractor could be that you drove it around your yard. You don't have to use it for a lot, but you've got to like put it into service. And so if you've ordered it, but you haven't taken delivery yet, you can't say that you've placed it in service. Depreciation is, we take it on items that are really kind of, if you think about it, items that we use to produce other things that we're in the business of selling. So all of your equipment, tractors, trucks, processing equipment, all of that would be depreciable. Buildings and structures are also depreciable. And there's economic depreciation, which is basically a change in market value. And this we normally do use for like our balance sheets and different things and stuff. But when you, like you purchase a new car, you drive it off the lot and it's lost 20% of its value. And that's economic depreciation. But what I'm talking about this is tax depreciation. And this has really prescribed rules that you're allowed to take on assets to receive a tax benefit. And if the IRS puts a useful outlife on all the assets, and it also determines how long it takes to depreciate that particular asset. There's also some ability to take bonus to depreciation or accelerated depreciation, which means we take a larger portion, or even on some equipment, you can depreciate all of it in the year that you buy it. And so you can accelerate that. And so you can kind of forward put a lot of those expenses into earlier tax years, but then the advantage is you pay less taxes in those years, but the disadvantage is you have fewer deductions to pay in later years, or to take off in later years. So you're required to take depreciation if you are a business on your business assets. When the asset is sold, you're required to pay back the tax benefit of depreciation through depreciation recapture. And that's getting a little technical. You don't need to necessarily know it, but I wanted to make sure that kind of it was in there just as to say a heads up. So generally, you've got MAKERS or ADS. Those are acronyms with the IRS that are Modified Cost Recovery System. And I can't remember what the ADS stands for, but basically the IRS has tables of that based upon that life of the equipment on what % of the cost of getting the item can you deduct in each year of its life. And then you have rapid accelerated, and this is what I was talking about with having that heavy loaded in that initial year. And we have two things for that: bonus or Section 179. Section 179 allows all or some of the cost to be deducted in the first year that you purchase it. Bonus or special basically does the same thing. The bonus depreciation has what started out higher, and it's over the tax rules it's been going down. And right now it's scheduled, I think, to completely eliminate in 2026, but we may get some differences if we get new tax laws passed. So be careful, like I said, because you may use some really generous Section 179 or bonus depreciation, and it can get you into financial trouble in the future. So that's one thing to consider. And then income. So there's also some income deferment. That's mostly going to be from crop insurance and some other types of things. So I'm not going to get into that here. And then income averaging. It's only available for farm income, and it's probably underutilized. But basically, if you could, they're really faint here, but you can see like this is the top of where the 10% rate is for each of these years. And this is, so the income below here would be taxed at this lower 10% rate. And then income between these other lines and that line would be taxed at the 10% rate. And then income above this is taxed at a higher rate. And so the orange bars are showing this farm's income in the 2019 to 2022. So somewhat stable these 3 years, but in 2022 it was a lot higher. And so all of this above there would be taxed at a higher rate. But income averaging for farm income, only available for farm income, would allow you to basically go back and average it out with these other years. And so it would take these upper amounts and basically top off these other years, so you could keep it down in this 12% rate instead of needing to pay a higher rate for it. You may have to be generally self-employed individuals, which people that have their own businesses are called self-employed, must pay quarterly estimates to the IRS. There's some special rules for qualified farmers. in that you don't have to make quarterly estimates if you file your tax return no later than March 1st. And if your withholding for the tax year is 67% of the tax shown on your current year or 100% of the taxes shown on the previous tax years. But that's just something to be aware of, that you might need to make those quarterly estimates. If you're required to make an estimated tax payment, you may make a single payment by January 15th of the required filing year for the whole year, basically. And so that just kind of heads up, you might need to do quarterly estimates if you haven't done those before. Some good practices: find a tax preparer early, spring, before farming and ranching gets busy. Meet in November or December for tax management. They'll need your year's records up to that point. In January, send out your 1099s and W-2s. January and February, provide records to your tax professional. And then March and April, file your tax returns. And so that's kind of your calendar tax year. And then the other thing that I wanted to bring up is in 2017, we had the Tax Cuts and Jobs Act that changed a lot of things, and but put in a lot of expiring provisions that are scheduled right now to expire at the end of 2025. But new tax laws can be passed anytime, and there's been some indication that they may be passing a tax law that would have some significant changes during this next calendar year. So I would say just kind of keep aware of some of the news and see if that happens. So the ruraltax.org website, this is where I told you we have these materials and stuff, and I'm going to actually go on there briefly and show you what some of those are. And let's see. So here's the Rural Tax website. And if you click on tax topics, you can go to all topics. And these are some pages with collections of some of the topics. So like the grant programs, disaster tax information, if you're a new farmer. And this is also be good for a new food business too. Not exactly everything's going to apply, but most of it will. The tax management. So some of these things that I've gone over today. So like if you click over here, you're going to find some topics on that. And then if you scroll down, these are the links to the webinars that we had on farmers.gov. And so you can watch those webinars and go back. And the same thing with this grant program. So we've got the webinar for the grant programs, also the 1099s. And then these are short articles. So just kind of providing an overview. So the grant and government program payments and tax information. So evidently I've got a broken link there because it keeps taking me to this instead of the actual article. But so you can go into here and then scroll down. And so you can see just a lot of different, so the 1099s, I talked about those. You can find more information there. Some tips on working with a tax professional, managing income taxes before the year end. Farming and who's a farmer. So you can see that there's a lot of information, and a lot of those also have the webinars attached to them. And so that was the, so ruraltax.org is really your source to go there. And then thank you for attending, and we are going